Can you talk to us about the implications on the gold and silver markets and the direction you see those at the moment?
Well, in conjunction with manipulation of interest rates, there comes a point where when the price of gold and silver is controlled and kept too low for too long, that it distorts the real world supplies and the real world demand. And I think you could argue that's what we're seeing right now. Now, from a bullish standpoint, technical standpoint, last week we saw what's called the golden cross in gold, where the 50-day moving averages crosses above the 200-day moving average. From a technical standpoint, which, look, I'm not a big fan of technical analysis within a rigged market, but nonetheless, it is bullish and it should get more attention by the money managers. But I think it's important to note, following the same theme that we've talked about, look, I've been saying for a very long time that the bleed down in inventory from the top on down has created an environment where the rhetoric and the price that we see is being betrayed by the most sophisticated and well-funded investors on the planet, drawing down supply. Case in point, last Friday, I believe it was Friday, January 11th, whatever day that was, 7 days ago, 1,200, actually that'd been Monday, I think. Well, whatever, it's irrelevant. But 1,223 contracts of spot gold. Spot gold, when you buy a contract at spot gold, that means for delivery. 1,223 contracts of spot gold were sold on January 11th. That means someone purchased $229 million in 100-ounce gold bars in one sitting. One day, one group purchases $229 million worth of gold. And then just a few days ago, another 505 contracts were sold, most likely to that same purchaser, worth $96 million. Two transactions for delivery off of COMEX totaling $335 million, $330 million, whatever the number is. Who's got that kind of bread? When we are seeing a bleed down from the top on down, it's not just in silver, it's in gold too. Yet these are movements that are not being identified because of the suppression. Now, let me try to explain to you all how this suppression is done in a very easy way to understand. So I asked my trading desk, what do we need in our margin account to control a 100-ounce gold contract? Because we hedge all the metal we buy. I was trying to figure this out to make it really easy for people to understand. Get this, as of last week, a 100-ounce gold contract, futures contract, worth at the time, it was 187,760 worth of gold, only requires $6,900 in our margin account. That's it. So with $6,900 and a very small amount for the trade, just a few bucks, you can control $190,000 worth of gold. Now, what if I am a commercial bank or a central bank and I decide to throw $500 million into my margin account? I can create whatever perception of reality I want. And that's what has been done for a very long time. But what we are beginning to see is where the rubber meets the road, where technical standpoint, it's very, very bullish. But more importantly, the supplies of both gold and silver are being bled down to where if you are short and an entity stands for delivery, you're in trouble. So much so that the LBMA just came out the other day and said because of the unprecedented outflow of silver, some 10,000 tons in 2022, they say that if demand stays like it was in 2022, there will be not enough supply left for the LBMA in 2023. That's the biggest epicenter of metal in the world. Now, look, they are already telling us that silver on the LBMA is at the lowest level in the 140-year history of the exchange since they've kept records. And so now you have an environment where from the top on down, the big money has used the suppression of price to reposition themselves. Now, a lot of this, what I'm saying, is confusing when you look at the environment that we find right now in metals, where it's the best supply and lowest premium I have seen on everything we have, with the exception of Silver Eagles, for 3 years. For 36 months, not even close. It's confusing, but there doesn't have to be a correlation in immediacy between what the most sophisticated and well-informed and well-funded investors are doing way up here and what just happens to be in 23 allocations and the slowdown related to the holidays. It's a perfect environment. And if you want to do what the biggest money in the world is doing, then you take advantage of these premiums and of this availability right now. Because look, the truth of it is that the investing public owns virtually nothing in the way of precious metals. And if we see a continuing deterioration in the what is supposed to be the hedge, that being 10-year treasuries, which had their worst year ever on the 10-year treasury market, down 16%. At some point, there's going to be an exodus out of traditional assets and looking for something that the biggest money in the world has already shown us is the path they're taking, and that being real world commodities in your possession, which are not simultaneously someone else's liability, which leads me to one other point. And I know it's not what you asked me. You asked me about gold and silver, but let's talk about systemic reactions and unintended consequences. You know, there's a leaked video out there right now from the FDIC Systemic Resolution Advisory Committee, the SRAC. And basically, what the guy is saying is that he says, one of the FDIC members, he says, you have to think of unintended consequences of taking a public that has more full faith and credit, or full faith and confidence, rather, in the banking system than maybe the people in this room do, he says. And then he goes on to say that although institutions don't want to see a huge run on their deposits, they likely will soon, which will bring about the need to impose bail-ins. He says people need to understand that they can get bailed in, but you don't want a huge run on the institutions, but they are going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. He says the implications of what's being discussed at this meeting, if it gets out to the general public, will create unintended consequences. Well, Dunnigan, here's the reality of it. There's only $125 billion in FDIC assets, insuring $9 trillion in the bank. And so when you talk about misdirection that I've talked about forever, it's not just in price, it's also in information. We are being misdirected into believing all is okay in the bank. We are being misdirected into believing all is okay in traditional assets, regardless of the fact that they underperform tremendously. The third worst 60-40 split. Remember, the pension funds and the financial advisories and the insurance companies, they all use a 60% stock, 40% bond allocation. Most of them do. That's kind of the mantra. The third worst in history. So when you see the traditional forms of investment being really ransacked, and yet we're told to hang on because just like in 2008, it got better. But in 2008, they embarked upon a 12-year expansion of credit and low interest rates. And right now, what we are seeing is the opposite of that. With over $2.2 trillion in the reverse repo market, the banks are earning 4% from the Fed, some $650 million a week in interest to the banks, instead of lending it out into the system the way they did for the past 12 years. They are reining in credit, and it's turning into an environment where you have to start trusting your gut, not the information that the heads of these lying institutions are giving us, not the fact that premiums and availability is good right now in metals, when you see it being literally bled down at levels that no one's ever seen before, where last week, in 2 days, you see somewhere in the neighborhood of $330 million worth of gold delivered off the exchange. It's continuing, and we're all being misdirected by price and by rhetoric, and it's just more of the same. I think it's going to be a very, very interesting year, and it's already shaping up to be just by seeing what's happening on the deliveries off of COMEX last week.
Yeah, you mentioned some of these informed players removing physical metal from the exchanges. We've also seen that on the sovereign level with strategic materials. Certainly, we saw through COVID and a lot of the global supply chain interruptions and disruptions how important it is on many other industries when suddenly you have a critical material, a strategic material that you don't have access to, and how vulnerable individual countries have become by outsourcing and offshoring and that sort of thing, rather than trying to cultivate domestic supplies or find alternate supplies, et cetera, or stockpiling for that matter, critical materials. Can you talk to us about what just came out around the progression of the story about BRICS in the last week or so regarding rare earth elements?
Yeah, well, it came out and basically said, first of all, you had the president of Wadudu, I think is his name, and he is, I forgot the country. I'm sorry. I know it's President Wadudu, one of the small countries in the Eurasian zone, who basically came out and said that he's calling for a OPEC-style cartel of the rare earth metals. The majority of all of the rare earth metals, it was the article talked about, are held in China with I think it was 44 million tons that they hold within rare earth oxides that they have within their soil. The next closest is 20 million believed to be hidden in the Brazilian ground. So between Brazil and China, you have the majority of all the rare earth metals in the world. And so when we talk about going from a fossil fuel combustion engine model into a green environment, the majority of all of the elements needed to make batteries, as an example, are found within Brazil and China, part of the BRICS nations. We have a very little bit here and a very little bit anywhere else. China holds the majority of all of them. And then you have President Wadudu come out and say, hey, well, we should impose a OPEC-style cartel for rare earth metals. And so, this is not a very well thought out policy where we go from the frying pan into the fire, as far as I'm concerned. But that article that came out in Mining and Metals on January 13th basically says that, according to the U.S. Geological Survey, 44 million tons are found in China, 20 million tons are found in Brazil, and that's the lion's share of the rare earth metals that are found geologically around the globe.